U.S. President Joe Biden is seeking to reassure Americans as fears of another U.S. banking crisis rise. The president is trying to calm fears after the collapse of both Signature Bank and Silicon Valley Bank. Stock markets around the world are largely down as investors wait to see what happens next. The two bank failures are the second and third worst in U.S. history. A short while ago, President Biden tried to reassure Americans that their banking system is safe.
All customers who had deposits in these banks can rest assured. I want to rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will be, and this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the Deposit Insurance Fund. Because of the actions that our regulators have already taken, every American should feel confident that their deposits will be there if and when they need them. Second, the management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. Third, investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works. And fourth, there are important questions of how these banks got into the circumstance in the first place. We must get the full accounting of what happened and why those responsible can be held accountable.
Our correspondent Michaela Kufner joins me now from Washington. Michaela, the U.S. president, they're trying to calm the markets and, most of all, American taxpayers. What else did he have to say?
Yes, clearly, this was an attempt by the U.S. president before the markets opened to basically contain the fallout from these two large failures, the second and the third largest banking failures in U.S. history, emphasizing that the taxpayers will not have to foot the bill. This, of course, after there was so much sweeping criticism after the 2008 banking crisis that saw taxpayers stepping in to save banks, this all being cited that it's in the public interest. Now there was several times a reference to the Federal Deposit Insurance Corporation. This is the agency where banks have to pay into exactly for situations like these so that they can then be stabilized. But the emphasis here on the depositors, the customers of the banks being compensated and not the investors. And at the same time, of course, there's always a political element to this because this lays Joe Biden open to criticism from the Republicans. He's just come out of very high inflation, managed to stabilize that and sell that as a success. So it's very untimely for him.
What concrete action is the U.S. government taking to stop this banking collapse becoming a much bigger crisis?
Yeah, well, it has taken control of these two banks, effectively now being in charge of compensating the depositors. At the same time, it is sending the signal that other banks will now get cash from the Fed. They are being shored up, basically to protect them from that very same risk that they have this high inflation to fight with, that they may have to pay out more than they have access to in terms of cash at this very moment in time. Although, of course, one has to point out that those two banks that are affected, they are pure venture capital. They are the ones that invest, particularly the Silicon Valley Bank, in high-risk startups in the Silicon Valley. Only a fraction of those ever actually manages to turn a profit. And this particular bank had too many risks open as it was being hit with high inflation and a rise in interest rates. And big questions now, of course, being asked whether this is a regulatory issue. And that's something Joe Biden also addressed. He wants to take this to Congress and basically share the responsibility also with the Republicans to get this under control.
You mentioned it before briefly. Biden's political rivals are already using this against him. How much of a political headache could this become for the president?
it could become a huge political headache because unemployment is down. He'd managed to stabilize the inflation here. It is also going down, and this could ruin that for him. Also, Janet Yellen, now the Treasury Secretary, previously in charge of the Fed. These are all policies that are coming into action now that were designed during Joe Biden's time as vice president, although he points out that Donald Trump stripped away some of the regulations. So we're going to see a lot of debate over that right now. And in the end, one analyst said that how big the fallout is now pure psychology. And that's where the debate about it matters at least as much as what is being done about this very crisis, because it is very different in nature from the 2008 banking crisis. It has a lot more parallels to the 1980s, where you saw Paul Volcker, the then Fed chief, raise the interest rates in double-digit figures, actually risking a recession in the country to get on top of inflation. Now, this is something that doesn't seem on the cards right now, but it's the psychology that matters, and in the end, how the Americans feel about it, how they're being basically chaperoned through this crisis, and that doesn't affect their deposits. And this is something that Joe Biden has stressed here time and time again. No taxpayers' money and depositors protected, not the banking fat cats.
Washington correspondent Michaela Kufner, many thanks. And for a deeper dive into what's going on in the U.S., my business colleague Stephen Beardsley is here now. Stephen, can you put this into perspective? How big of a deal is this really?
Hey, Nicole, yeah, this is definitely the biggest financial institution to fail since 2008. So that's one of the reasons why so many antennas are perked up here. Altogether, it is among the wealthiest banks, or the most important, the largest banks in the U.S. It's not amongst the top 10 or anything, but it's considered a regional bank, $175 billion in deposits, a little over $200 billion in assets. That makes it one of the top ones, not the absolute top echelon, but it serves a very important region. That is a very wealthy region, Silicon Valley. That means that a lot of notable companies have their money in large amounts. So it has a very specific service, a very specific market that it serves, and other banks that have similar profiles are now getting a lot of attention.
So how did we get here? What went wrong?
Well, it's basically mismanagement from everything that we can tell. What happened is that in the last year, we've seen interest rates being raised so quickly by central banks around the world that many assets have lost their value quickly. And that means that when your assets are losing their value, that's going to be a problem when you need to cash them in, when you need them. And in this case, SVB was seeing that a lot of its deposits were running down because these companies were having such a hard time as well. They were burning through their cash. They were drawing larger amounts out. It needed to cash in some of its assets, but the value had fallen dramatically, and that sent off alarm bells for many people, and suddenly there was an old-fashioned bank run. So in many cases, this does have an echo from earlier times, especially when you look at the nature of a bank run and the fact that so much of it is psychological. People were worried, they went in and they grabbed money out, but there's still a question as to whether the underlying fundamentals were really so dramatic to merit that.
How big are fears of a snowball effect, of people panicking in this throughout the banking system?
Yeah, as I mentioned, right now we're seeing investors looking at banks with similar profiles. That is, those that are devoted to tech companies in particular. We saw the Signature Bank has a special exposure to the crypto industry. And so that's where they're targeting. Right now we're seeing that another bank, First Republic, is under a lot of pressure. It was down 65% today. And we could see action on that very soon. So anything that's in that sort of regional size, sort of more larger than a mid-sized bank, but also especially serving these certain communities that are burning through cash. You've seen all the tech layoffs, for example, right? We know that these companies are under fire. They're burning through cash. They're perhaps pulling their deposits out. And these, the assessment is that these banks could also have similar exposure to these same kinds of devalued assets as SVB and Signature did.
We're looking back at 2008 right now, quite nervously. What do you think are the chances of history repeating itself?
I mean, I think it's definitely too early to say, and I think a lot of the underlying elements here are very different. When we look at 2008, there were basically worthless bets made on sort of crazy instruments, mortgage-backed securities. There was a lot of fraud going on there. There were a lot of people who were getting loans that shouldn't have gotten loans. Those were being packaged together and being sold as instruments that were worth something, but ultimately weren't. When you look at SVB, a lot of what lost value were actually the most reliable assets out there, Treasury bills. The problem is that these interest rate hikes have happened so fast that they did a poor job of hedging those losses. And so they were caught with their pants down. And now there are potentially other companies that are in a similar situation, but I would be hesitant to really say this is going to lead to the same kind of general system contagion that we've seen elsewhere, a similar kind of problem, because there was a fundamental problem with the assets back then that we're not quite seeing right now, but there are big question marks, and there is a contagion, a psychological aspect to this as well that could move on to other banks, for sure.
Stephen Beardsley, many thanks.